For most of human history, wealth came from making things: food, steel, machines, roads, ships, economic. Power was tied to production, the ability to transform raw materials into something valuable through labor and innovation. But today, something feels different. Stock markets rise while factories close, real estate booms while wages stagnate, company valuations soar without selling more products, and the strangest part, entire fortunes are built not by producing goods, but by issuing debt. So here's the mystery. How did we move from an economy where wealth came from production to one where wealth increasingly comes from credit creation? To understand this shift, we need to go back to when money itself began to change. Act I Origins. When production was the engine in the early industrial era, wealth generation followed a clear pattern. Businesses invested in tools, hired workers, extracted resources, produced goods, and sold them in markets. Profits came from efficiency, making more output from fewer inputs. Factories expanded economies. Infrastructure multiplied productivity. Trade created specialization. But financing these activities required capital, real savings. Banks acted as intermediaries, lending deposits from savers to entrepreneurs who used those funds to produce tangible goods. Production came first. Credit followed. Money largely reflected real activity in the economy. That began to shift as financial systems evolved. With the rise of modern central banking institutions like the Federal Reserve, monetary policy gained the ability to influence credit conditions on a massive scale. Interest rates could be adjusted, liquidity could be expanded, supply of credit could grow even if real savings didn't, and that changed the sequence. Act 2. The Rise. When credit became the catalyst, fractional reserve banking introduced a subtle but powerful dynamic. Banks no longer needed to lend only what had been saved. They could extend loans by creating deposits, expanding the money supply in the process. This meant investment no longer had to wait for prior production. Credit could finance activity in advance. At first, this accelerated real growth. Factories were built faster. Railways expanded rapidly. Businesses scaled beyond what internal funds would allow. But gradually, credit began financing something else: assets, homes, stocks, commercial property, financial instruments. Instead of funding new production capacity, increasing volumes of credit were used to purchase existing assets, driving up their prices. Higher prices justified more borrowing. More borrowing pushed prices even higher. A feedback loop formed. And unlike production, which faces limits like labor, time, and resources, asset prices could rise purely through financial demand. Wealth began to appear without new output. Act 3. Breaking point. When finance outpaced industry by the late 20th century, advanced economies began to see a structural shift. Manufacturing employment declined. Service sectors expanded. Financial institutions grew rapidly. In 1971, under Richard Nixon, the United States formally ended the convertibility of the dollar into gold. Money was no longer constrained by physical reserves. Credit expansion became more flexible. Financial innovation accelerated. Derivative securitization, leveraged buyouts, debt could be packaged, sold, and multiplied across global markets. Corporate strategies evolved. Instead of investing primarily in productive capacity, many firms discovered that borrowing to repurchase shares could increase earnings per share and boost stock prices. Financial engineering sometimes delivered faster returns than building new factories, and markets rewarded it. The value of companies became increasingly tied not to production, but to capital structure. Act for fallout. The asset economy emerges. As credit flowed into financial markets, asset prices rose across the board. Real estate appreciated. Equity markets expanded. Bond valuations surged. Those who owned assets saw their wealth grow. Those who relied on wages saw slower gains. Income began to diverge from asset appreciation. And here's the deeper effect. Rising asset prices increased collateral values. Higher collateral allowed for more borrowing. More borrowing fueled further asset inflation. This transformed balance sheets into engines of wealth creation. Wealth could now grow simply by holding appreciating assets financed by credit. Production still mattered, but increasingly, valuation changes driven by financial conditions played a larger role in perceived economic growth. Act V failed FIX's policymakers recognized the risks of excessive leverage. After the 2008 financial crisis, regulatory reforms were introduced to limit risk-taking by banks. Interest rates were reduced to stimulate real investment. But low borrowing costs also encouraged continued asset purchases. Attempts to normalize policy often triggered market instability. In 2018, rising interest rates led to equity market volatility. In later tightening cycles, higher rates strained housing affordability and corporate refinancing. Each time, the dilemma remained: restrict credit and risk slowing the economy, expand credit and risk inflating asset bubbles. And because financial markets were now deeply integrated into economic stability, policymakers often prioritized liquidity. Credit expansion resumed. Modern parallels, the pattern continues today. Global financial assets vastly exceed global GDP. Property markets in major cities are heavily influenced by mortgage. Credit availability. Corporate debt issuance frequently funds financial restructuring rather than new production. Equity market capitalization can rise even during periods of modest output growth. Each cycle follows a familiar sequence: credit expansion, asset appreciation, collateral increase, further borrowing, valuation gains, and because wealth effects influence consumption. Rising asset prices can sustain economic activity even without corresponding increases in production. The result? An economy increasingly sensitive to financial conditions. Interest rates shift, and markets react immediately. Liquidity contracts and asset prices adjust. Production cycles still matter, but credit cycles increasingly dominate. 3 takeaways. 1. Credit creation has become a primary driver of asset values. Modern financial systems allow borrowing to influence prices independently of production changes. 2. Asset ownership amplifies exposure to credit conditions. Wealth tied to appreciating assets may fluctuate with interest rates and liquidity. 3. Financial stability and economic growth are now closely linked to credit expansion. Managing borrowing levels has become central to macroeconomic policy. A final THUGHT economic history has often been shaped by shifts in how societies generate and distribute wealth. The transition from production-led growth to credit-influenced valuation may represent one of the most significant structural changes in modern economies. Understanding this evolution raises an important question. If wealth can expand through credit conditions, what happens when those conditions reverse? If you want to explore more about how financial systems shape real economies, subscribe for future deep dives into the mechanics behind modern growth. The forces driving markets today may not always be the ones we can see.